So good evening. So today, what I'll do is first, we'll take you all through the module or the course unit ethics. So ethics is one of the important area, right? Especially in the auditing and audit and assurance subject. Because simple reason being, the accountants are identified for being professionals who have a duty towards the public, right? Or a public interest. Simple reason is this, right? Now if you take an auditor's role, right? Now auditor audits set of financial statements and express an opinion on truth and fairness of the financial statement. For example, assume that auditor concluded that the set of financial statement audited by him shows true and fair view, and then report into that effect is given, and then the particular organization publish the audit report together with the financial statement. And the general public might rely on the report issued by the auditor, right, saying that the financial statement shows true and fair view, right, and so might be impressed with the financial performance and the position reported in the financial statement, and then might take a call to invest in equity shares of the particular organization, right. Now auditor says this financial shows true and fair view, massive profit being shown, good financial position being shown. So believing or the rely on the auditor's report, right, say the investors, general public might take a call, okay, look here, this is a good entity to invest, and might invest their money in this particular organization. If the later on found that the report or an opinion given by the auditor was not correct, right, the particular organization profit is much less than what was reported, the auditor has not detected a significant fraud and error, and the particular organization share price might significantly reduce. Now who will be affected ultimately? General public or the shareholders, general public who bought the equity shares based on the auditor's report. Right now, the shareholders of the company will be affected. So if they relied on the auditor's report, which went on to say that the financial shows true and fair view, meaning profit reporter shows true and fair view, financial position reporter shows true and fair view. So therefore, the general public relied on auditor report and took a decision. So later on found that report given by the auditor was wrong. Therefore, general public is affected. That is, the auditor gave an inappropriate opinion. Similarly, for example, if you take the accountant working in a particular organization, finance director or finance controller who was working in a particular organization, now has produced certain set of financial statement which is not accurate, right? So the general public took a decision based on those financials, or the bank might have taken a decision based on those financial statements and might have been affected. So therefore, the accountancy profession, unlike the other professions, right, is identified as a profession which has a duty towards the public. Identified being a profession with the public interest, because public rely on the statement produced by the professional accountants and take the decisions. If the accountants or the professional accountant does not deliver, or does not the work accurately, or does not provide reliable information, ultimately general public is affected. General public is affected. For example, if you take a doctor, right, if doctor does not treat a patient, right, only the particular patient might be affected, right. But if a professional accountant, right, so does not provide a reliable information, not only one person, several persons might be affected. For example, you provide inappropriate audit opinion, thousands of the people might rely on the particular report and invest in equity shares. If that particular company is bankrupt, now see what will happen. Does only one shareholder will be affected? No, right? If a doctor treats, probably only one patient will be affected, or his family will be affected. But if the professional accountant gives an inappropriate opinion or inappropriate report, right, so then thousands of people might rely on that and make investment, make financial decisions. If the report was wrong or found to be inaccurate later on, right, so those thousands of people might lose. So therefore, unlike other professions, accountancy profession is identified being a profession with public interest. If you do not deliver well, if you do not deliver accurate, so what will happen is general public is affected. So therefore what has happened is, International Accounting Standard Board, right, has developed, sorry, not International Accounting Standard Board, IFAC, International Federation of Accountants, have come up with code of ethics, right, code of ethics to be followed, right. Is ethics meaning set of rules or set of guidelines to be followed by professional accountants in providing their services. Since public is affected due to our work, IFAC has given certain guidelines, certain rules, certain regulation to be followed by us in providing services to the employers or our clients. So that, so we will ensure, we can ensure that, that we provide relevant, reliable, accurate information for the public, and public will not be affected due to relying on the information that we provide, right. So that is the objective of, right, having this code of ethics. If you will take the code of ethics, issued by IFAC, it has basically 3 sections: section A, section B, section C, right. Section A deals with framework, kind of framework or a common ethical principle or common principles to be used, right, or a common guidelines to be used by the accountants in practice and accountants in business when they are performing their duties. Now, for example, if you will take accountants, professionally qualified accountants, right, they can be divided into 2. One is accountants in practice, other one is accountants in business. Accountants in practice refers to the accountants working as auditors, tax practitioners, right, or the consultants, right. So defined being accountant in practice. For example, my duty or my job is, for example, work as an auditor, or working as a consultant, working as a tax practitioner, right. So they are defined being accountants in practice. Whereas accountants in business refers to the accountants working, or a professional accountants working in the business organizations in the capacities of, say, the accountants or the finance managers, finance controllers, finance directors in various capacities. So accountants working in the business organizations are defined being accountants in business, right. So the professional accountants working as auditors or the tax consultants or the consultants are defined being accountants in practice, right. Now certain ethical principles, certain ethical guidelines are applicable for both. Certain ethical guidelines are applicable for both, whereas there are certain ethical principles, that to be complied with only by the practitioners or the practicing accountants, whereas certain ethical principles to be complied only by the, right, so the professional accountants in business, right. Certain the certain ethical principles are to be complied by both, equally applicable for the accountants in practice as well as in the business, whereas there are certain principles to be followed only by the accountants in practice, certain principles to be followed by only the accountants in business. So therefore now section 1 of the code of ethics deals with, so the ethical principles to be followed by both accountants in business as well as accountants in practice, whereas section B deals with, so code of ethics to be followed only by the accountants in practice. Third one is, the code of ethics only to be followed by the accountants in business, right. So but in your syllabus the main focus will be on, right, ethics to be followed by both section 1, right. So both accountants in business as well as accountants in practice. So I will be taking you all through that, section 1, section, because that's the most important one. Others are very specific, for the accountant in business and the accountant in practice. For example, if you will take the accountant in practice, it says, okay, independence, right. The accountant in practice will have to be independent. To ensure the independence, what measures will have to be taken is there in the code of ethics, section B, right. So likewise, but if you take the section 1 is the core, right. So which need to be complied with by both practice and in the business, right. So the first part of the story is clear. Being the accountant, we have a public interest, duty toward the public, right, a profession which has a public interest, right. So therefore, so if we do not do our job well, what will happen? Thousands of people will be affected. General public will be affected. Therefore, IFAC has given set of guidelines to ensure that we do our job correct. We deliver our service correct. We provide relevant, reliable, accurate financial information for the stakeholders in taking decision. So that is the first part of it. Okay, this framework. Framework right at the beginning. Framework for ethics, code of ethics. Right at the beginning goes on to say that there are steps to be followed by the accountants, professional accountants in dealing with the ethics. Dealing with the ethics. For example, if we come across an ethical issue, how to deal with it, right? It's been specifically stipulated. We'll see those 3 steps. First one is identify threats to compliance with the fundamental principle. Now, there are some fundamental principles, meaning principle to be followed by the accountants in business and practice, right? First thing what you got to do is identify the threat. Identify the threat to comply with the fundamental principle. What is the threat which is available for you to comply with a particular principle? Identify, okay, what is this particular threat, right, which will prevent you complying with the fundamental principle will have to be identified first. Second one is what? Evaluate the significance of the threat. Evaluate whether it is quite significant or a least significant or no significance, right? Identify, whether it is significant or not. Third one is apply safeguard when necessary to eliminate the threat or to reduce them to an acceptable level. So then you take certain measures. You take certain measures either to eliminate the threat entirely or to reduce the threat to an acceptable level, right? First one is, okay, identify the threat. Identify the threat. Second one, evaluate the significance of the threat. Second one, evaluate the significance of it. Third one, take appropriate measures either to eliminate it or reduce it to an acceptable level. Now, we will come back to this particular slide little later. Once we identify these are basic principles or fundamental principles to comply with, right? Then only you all can understand this particular the slide well. Okay, now we'll see what are the fundamental principles. What are the fundamental principles to be complied with by the accountants, whether in the business or in the practice? We'll see the first one, most important one, integrity. What do you mean by integrity? Right? So this refers to be straightforward and honest. You have to be straightforward and honest. Being a professional, have to be straightforward, right? So when there's an issue, either for example, yes or no, right? You give your opinion, right? Be straightforward and honest. You have to be honest in all your dealings with your client and the employer. You might be an accountant in practice, then with your client. You should always be straightforward. When a client, for example, make a request, if it is not acceptable, tell, okay, client, no, this is not acceptable based on our client, based on our ethics. If your employer make a, for example, some request, right, which cannot be accommodated based on ethical guidelines, you inform your client, look here, my employer, so I cannot, agree on what your recommendation or agree on your recommendation because it is not in compliance with ethical principle. So therefore, you have to be straightforward and honest in all your dealings, maybe with your client, maybe with your employer. Therefore, always be honest and be straightforward when it comes to your dealings. Is the first one. Second one, there again another very important one, objectivity, right? Objectivity, right? Meaning what? To not allow what? Bias, right? You should not allow to be biased, right? Second one, conflict of interest or undue influence of others to override professional or business judgment. In your professional or business judgment should not be, right? You should not allow, to not allow bias, right? Sorry, to not allow bias. Right? To not allow bias. Don't allow to be biased. Don't allow to have a conflict of interest or undue influence of others to override professional or a business judgment. So there are many instances where, right, you have to make certain estimations, assumptions and make certain judgments. In all these circumstances, you should not be biased towards any of the stakeholders. Right, objectivity meaning you should be, the objective, right? You take, because you are being a professional accountant, right? You are being taught certain, technical principles. So the technical standard. So whenever you take the decision, take those decisions based on the technical standard you have learned. Technical standard applicable for your profession. Don't be biased. For example, the management might say that, okay, make at the moment, for example, bad debt provision. 100 million provision need to be made. If you make 100 million provision, your profit will go down. Right? Your profit will go down. For example, management might make a request, okay, don't make a provision of 100 million. We'll make a provision of 80 million or a 60 million or a 40 million. When you make a provision of 40 or a 60 million, what might happen is your profit goes up. Your profit goes up, but again your asset will also be overstated. So what will happen is your profit and asset both will be overstated in the event you do not make the required provision. If you listen to your employer and understate the provision, what happens is you are biased towards the management. Now your decision was, biased towards the management. When you are not biased, for example, you have objectively worked out the provision required for the bad days. When you objectively work it out, you realize that 100 million provision was required for the bad days. Or 100 million allowance was required for the receivable. 100 million impairment allowance was required for the receivable. So what happened was, when 100 million is provided in the financial statement, so what happens here? Profit goes up. So management might not like it. So management might request from you, so being the accountant, from the accountant that, okay, look, accountant, 100 million is too much. Our profit will go down. So reduce the allowance to 20 million or 30 million. When you reduce the allowance to 20-30 million, the profit goes up and your asset goes up. If you listen to your employer, so what will happen is, right, you will be biased. Right, when objectively do it, 100 million. So when you make the provision based on the request of the client or your employer, right, you make a provision which is less than what is actually required. So therefore you should not be biased. Objectivity meaning, right, should not be biased, right? You should not, allow conflict of interest or undue influence. It can be on the conflict of interest. There can be conflict of interest, right? Or undue influence of others to override professional or the business judgment. Your professional judgment or the business judgment was 100 million provision was required, right? What's in the shareholders are telling, somebody else is telling, now you take a decision, the override which override your professional judgment, right? So the objectivity concept, what it says, objectivity principle, what it says is you should not allow, right, bias, right, and conflict of interest or undue influence, conflict of interest, right, or undue influence, right, to override professional or a business judgment. Very important principle to be followed by the accountants. We'll get back to this also a little later again. Professional competence and due care, right? So you all might have heard this particular concept again. So what it says is, right, say to maintain professional knowledge and skills at the level required to ensure that client or the employer receive competent professional services in line with the current development in the practice, right? So the accountant got to ensure that he is always equipped with, right, current knowledge, right, current knowledge, so that appropriate or relevant or a good service can be provided to the employer and the client. For example, what happens is I might have qualified, for example, 10 years ago. Later on, for example, since the day I was qualified as an accountant, thereafter, so a lot of the standard might have been introduced. Tax laws might have been changed, or the Companies Act might have been changed. If I have not updated, with all these changes in accounting, auditing standard, and then the tax laws, Companies Act and all that, will I be able to provide an appropriate service for my client? No, I will not be able to, because I am not updated. whatever the service, I am offering, or whatever the advice I am offering for my client might not be accurate, or might be outdated, or might not be accurate. So therefore, it is the duty of the professional accountant to ensure that, the professional competence and professional competence is always updated with the latest development in the profession. Is updated with the latest development in the profession. Can be accounting standard, can be auditing standard, can be tax laws, can be other laws and regulations. Right? So whatever the laws and regulations applicable and relevant for the profession, he should be updated. He might have acquired the professional qualification 20 years ago, but yet, so when you provide those services, to the client, you got to ensure that you are updated with all these latest rules and regulations, right, and the standard, etc., so that you will be able to provide an appropriate service for your client. And in addition, it goes on the due care. When you provide, services to your client, you should exercise due care, right? So don't do careless work, right? So the whatever the work, you have to understand what is the work required by your client. You have to understand what kind of knowledge or a competency you require in providing the particular service. And then if you don't have the knowledge, gather that knowledge or get the service of a, another known party. And then ensure that you provide a quality service for your client. So therefore, don't do careless work. So therefore, what it says is, so whenever you provide a service, you need to have the latest, right, technical and all other knowledge required to provide good service to your client. Whenever you provide a service, you have to exercise due care, right? Having understood the particular client's, the nature of the service required, and the knowledge you need to provide the particular service, you should exercise due care in providing the particular service is this particular principle. So then we'll get into the next one, right? So the next one is confidentiality, right? So confidentiality also is a very important concept, for both. Now, while the accountants in practice work as an audit, accountant in practice, carrying on an audit, he might get hold of lot of confidential information, so which others might not have an access to. For example, whenever you conduct an audit, you can request any information that you require in conducting the audit. Client will provide any information that require, so in conducting your audit. Similarly, if you take the finance director and finance controller, right, will get hold of many confidential information of the particular organization. Cost of the individual products being produced. So gross profit margin and the net profit margin kept, right? Raw materials used and the suppliers from whom the raw materials are purchased. For example, formulas used in producing the products. For example, take a product like, for example, say the biscuit. You might be producing a biscuit, which has a, say, 80% market share. There is a competitor, who produces the same kind of a biscuit, has a 20% market share. If for example, the formula that you use, the raw material that you use, right? Raw material A, B, C, D, whatever it is, in what quantities, right, is available for the competitor, what will happen? You will lose your core competency. Competitor will also produce the same type of product. And then what will happen is you will lose your market share to your competitor. Okay, you had a secret. For example, formula. You had a formula of using certain raw materials, right? And then the competitors, right? If competitor can get hold of that, competitor can make an undue advantage. Competitor can make an undue advantage out of it. So therefore, so what it says is, whether you are an accountant in practice or the accountant in business, you will get hold of lot of confidential information. You will get hold of lot of confidential information. So what it says is, this confidential information should not be used for your own personal advantages, right? So should not be disclosed to any third party. Should not be used for your own personal advantage. But there can be certain circumstances where law or other regulation might require you to disclose. In that kind of a situation, yes, you have to disclose. But if not, for example, government law or regulation require you to disclose certain information for them, you cannot say no, right? You have to disclose such information. But if not, generally the principle is, whatever the confidential information you will get hold of while carrying out your duty as an auditor or an accountant should not be disclosed to a third party. Should not be disclosed to a third party. Should not be used for your own personal advantage. Should not be used for your own personal advantage. But, so in the event a regulator or a law require you to disclose such information, you are permitted to disclose such information to another, whatever the particular third party. Right? That is called confidentiality. One of the very important principle. One of the very important principle. The last one, professional behavior to comply with all laws and regulations applicable. So when you are an accountant, when you are a professional accountant, so you got to ensure that your behavior is a professional behavior. Meaning what? You got to comply all applicable laws and regulations, right? All applicable laws and regulations to your profession, right? Or your industry or of your business, right? For example, if I am a professional, right, I got to ensure that my behavior is a professional, right? Got to ensure that I do comply with generally all laws and regulations applicable, right? So in the business or in the country or whatever, right? So that I can say that okay, I am a professional. I do comply with the laws and regulations generally applicable for my profession. So in my country. Because otherwise, so you might be an accountant, you might be a doctor, for example, if you do not comply with, generally, for example, applicable laws and regulations in your profession and the generally in the country, you might not be respected, no. You might be criticized for not being complying with the applicable laws and regulations in your profession and the country. You might not be respected, you might be, taken to the court and, sued and all that. So therefore, in our profession also, what it says is, if you are a professional accountant, right, you got to identify what are the laws and regulations applicable in your profession, so in your country, and then comply with them. Comply with them. So then only you will be recognized, respected, by the general public. So therefore, if you will take, now these are the 5 common principles, ethical principles to be followed. These are the 5 ethical principles to be followed by both accountants in practice and accountants in business. Accountants in practice and accountants in business. We will summarize it again. What is the first one? Integrity. What is meant by integrity? Being honest and straightforward. Being honest and straightforward. Be honest. Be straightforward. What is the second one? Objectivity. You should not be biased and should not, yes. So you should avoid, the conflict of interest or so the influence, a conflict of interest or the influence to change your professional judgment, change your professional decisions, right? You should not allow biasness or the conflict of interest or influence to change your professional judgment or the professional decision. Director will something like this. Or your, for example, spouse might be working in a particular organization. There is a conflict of interest. If your spouse is working in an organization as a finance director, can you audit that particular organization? Can you audit the financial statements of a particular organization? No, because you have a conflict of interest. Or you might have invested a fairly good amount of money. You might be a significant shareholder of the particular entity. Can you audit that particular entity financial statement? No. There is a conflict of interest. Right? Or somebody might make an influence, right? Okay, when you audit this financial statement, ensure that there is a profit in that particular organization. So whether it be conflict of interest or the biasness or the influence, right? You should not allow them to change your professional judgment. Somebody might tell, right? So might be having conflict of interest or somebody might influence, right? You should never allow any of them to change your professional judgment, right? That is the second one. What is the third one? Yeah, professional competence and due care. Meaning you should be competent, you should be knowledgeable with all applicable laws and regulations in your profession, right? You should be, the knowledgeable with, all applicable latest, right? Accounting standard, auditing standard, tax laws, companies act, all other regulations, so that you can provide an accurate service. Do you care? Whenever you provide a service, provide the particular service with care. What is the fourth one? Confidentiality, right? You should, whatever the information you will get hold of while carrying on the duty as an accountant or an auditor, right, should not be disclosed to third parties. Should not be disclosed to third parties. Or you should not use such information for your own advantage, right? Confidentiality. Last one is professional behavior. So being a professional, you got to understand, you got to identify, so the laws and regulations applicable, right, and comply with all of them, right? Comply with all applicable laws and regulations. Therefore, if you all take the accountants and business and accountants in practice, now these are the common principles or a common ethical principles to be followed by them, irrespective of the fact that whether in a practice or the business, right? So these need to be complied with. Right now, what we are going to discuss is, now what we discuss is the principle. Now, what are threats? We can remember that, the previous, my second slide, what I explained you all. First, you have to identify, what are the principle, ethical principle. Then, what are the threats? So, which will not allow you to comply with those ethical principles. Now, what we are going to discuss is, what are the threats? So, which will prevent, right, professional accountant being not complying, right, not complying with these ethical principles applicable for them. First one, self-interest threat. What do you mean by self-interest threat? So, you are having a material interest, right? Threat that a financial or other interest will appropriate. It can be financial, it can be other, right? So, interest will appropriately influence the professional accountant's judgment and behavior, right? Self-interest threat. For example, so one of the threats, for example, you are the main shareholder of the particular entity, right? For example, you are auditing set of financial statement of an entity. You are the second or the third major shareholder. When that is the case, now you have a self-interest, because you might not want to see the particular organization profit going down. When the profit goes down, what will happen? Share price will go down. The share price will go down, what will happen? Your value of your investment will go down. So therefore, now there is an entity, right? You are the second main shareholder. In that particular organization, the profit goes down, share price will go down. When the share price goes down, your value of the investment goes down. So therefore, value of your investment will go down. So therefore, I might not want to see the profit going down. So therefore, whenever I take a call about the depreciation or the allowance for receivable or the provision for bad debts, whatever you call it, right? So I might not be, for example, my decision might be influenced by the self-interest rate. For example, when 100 million provision is required, I know that if 100 million provision is provided, then profit will go down. Share price will go down, I am affected. Therefore, what will I do? I will, reduce the provision and increase the profit, so that market value will go up and my value of investment will go up. So therefore, my professional judgment or professional behavior was influenced by what? The self-interest rate. If I did not have self-interest, I would have provided 100 million. But since I am the major shareholder or the second or the third major shareholder, right, since the full provision is done, if the full provision is done, profit goes down and the share value goes down and my investment goes down, what will I do? I will not provide 100 million. I will not get them to provide 100 million. I will say, okay, 20 million provision, which will result in profit, assets and the share price, everything to go up. So therefore, self-interest threat is a threat. So due to you having a material financial interest or other interest with the particular entity. So one is what I said, is financial interest. You are a main shareholder. Second one, for example, assume that you are one of the supplier to the particular organization. You are one of the main customer of the particular organization. You are one of the main supplier to the particular organization. If the particular organization profit goes down, if the particular organization market share goes down, I know that I am affected. So because I am one of the main supplier to the particular organization. If that particular organization, when the profit goes up, if they lose their market share, and etc., I know that I will also be affected. No? When the market share goes down, their production will go down. When the production will go down, so the quantity of raw material that they will purchase from me also will go down. Therefore, I am affected. So therefore, it can be financial or other interest, right? Financial and other interests, might influence me in taking the professional judgment, professional decision. The one of the main threat, affecting the professional accountants, both in business and practice, is self-interest threat. You are having an interest in the particular entity, right? You are having an interest in the particular entity, so your decision will be affected, influenced by this particular financial interest or other interest you are having. The second one is called self-review threat. So what do you all think that what should be the what is meant by self-review threat? Self-review. Now it's like this, right? For example, now the information compiled by you, right? Self-review threat. You review, right? So information you have compiled, or you review information compiled by a colleague or a friend or another partner in your firm, or another staff member in your firm, right? So defined being, so the self-review is like, for example, if I have prepared a financial statement of an entity, I have prepared the financial statement of a particular entity, I am auditing the same numbers. I have prepared those financial statements, now I am auditing that financial statement. Can I audit that? I will be subject to self-review threat, no? Now I am auditing the financial statement that I produce. I am auditing the financial statement. Our client has said that, okay, I don't have an accountant. Why don't you come and do my accounts? Now what I did was I went and prepared the accounts and given to the management. The management is happy about the, okay, now the accounts are given. Now they want me to, okay, audit these accounts. Now when I am auditing the financial statement, I will come across material errors or material omissions. Will I go and inform the management that, okay, look here management, now there were certain errors in these accounts I have produced, or there were certain omissions in these accounts I have produced? Will I go and tell? I will not tell. So therefore, so there is a called self-review. If I am to audit, or if I am to audit the same number that I have compiled, right? Or I am the numbers not properly, I might not have compiled. Another partner of my firm might have compiled. Another staff member of my firm might have compiled. I have not produced, but the staff member has produced. Another partner, I know, not me, one other staff, my firm has produced this. Will I go and tell the management that, okay, there were accounts prepared? No. Because I know that, those were produced by some one colleague, one partner, one manager. So they will be subject to self-review threat. Self-threat are subject to self-threat. You are subject to, so review the information that you have or your colleague has produced. Right? Now read this. The threat that a professional accountant will not appropriately evaluate. Threat that you will not appropriately evaluate. You will not evaluate. For example, as I said, I will not appropriately evaluate, because so then my organization might be affected. Will not appropriately evaluate the result of a previous judgment made. Result of a previous judgment made or the service performed. Result of the previous judgment made or the service provider performed by the professional accountant or by another individual within the professional accountant's firm. In your own firm, somebody has prepared the account, somebody has given advice. Now I got to the audit that one. Then what will I do? I might not highlight the particular whatever the deficiency, if any, included in there. Right? It says threat that a professional accountant will not appropriately evaluate. I will not appropriately evaluate it. If I evaluate it appropriately, I know that is wrong. But will I go and tell that is wrong? I will not go and tell that is wrong, because then I am affected. My firm is affected. Therefore, I might not go and tell. So therefore, it says, right, what you got to do is, right, So one of the threat applicable is self-review. You are subject to, right, review the financial information or other information compiled by your own firm, right, or another colleagues of your own firm is called self-review threat. Next one, right, advocacy threat. Advocacy threat, right, meaning what? The threat that a professional accountant will promote clients or the employer's position to the point that the professional accountant's objectivity compromise, right? Read it well. Threat that a professional accountant will promote. Professional accountant will promote clients or the employer's position. Professional accountant will promote clients or the employer's position to the extent that, so your accountant professional objectivity is compromised. It's like this. Now assume that, okay, the accountant, say the auditor's client has come up with a bond issue or the debenture issue, right? And the particular company says, okay, our company is very strong. Company says, when the bond or a debenture issue is done, invite the general public to come and invest. They come up with a bond or a debenture issue and then invite general public or look at general public, come and invest in our bonds or the debentures. Our company is financially strong, very strong company, right? Now, if the audit also goes on to the public and say that yes, you all invest this particular company is a very strong company, very reliable company. The accountant goes to the finance director goes into the public and say that okay, the invest in our company, we are the strong, financial strong and healthy and etc. company, right? You are advocating that, you are telling that, so the representation made by management about the how strong the particular company is accurate, no? If I am going and telling that yes, invest this company is good and etc. I am saying what management is telling is accurate, right? So when I tell that, my objectivity might be threatened, no? So my objective might be compromised without having real knowledge. I might not be aware of that whether the particular organization is financially strong like they inform. The management might say when they want to issue all bonds to the general public, they will always say that their company is good. Otherwise, they might not be able to sell all the bonds or the debentures. Therefore, they will say the company is good. Now, being the auditor, if I am also telling that okay, this company is good, then invest in you, right? What will happen? That the professional accountant's objectivity is compromised, right? Threat that a professional accountant will promote clients or the employer's position. Right, you can say that okay, now you can make this kind of a statement. Now this company is credit rating. It has taken a credit rating from such an agency. It has got a A plus credit agency. It has got A plus rating. If we just say that okay, this particular company has got the credit evaluation by a credit rating agency where they got A plus. If that is the case, is objectivity compromised? Now the auditor. Your client is coming up with bond issue. Your client says that okay, they have got A plus from a rating agency. If you say that general public so this particular company is my client, they have got a plus from a well known credit rating agency. If you make a statement like that, will your objectivity be compromised? Is your objectivity compromised? What do you think? Is your objective compromised? No, your objective is not compromised. You just inform, you just make a statement of certain facts. So your client actually has got A plus credit rating from an agency. But if you make a statement like this, right? So the invest in this particular company's financial position is very good. They are a very strong company, right? So they are in the business for many years, very strong, very reliable, very good, very honest, etc. company. If that is the case, right, is your objectivity compromised? Is it compromised or not? Is it? Now it is compromised. How do you say that that is the most suitable or best company in the world? Or whether the particular company financial position is very strong, profitability is very strong, how do you say? We never know. So being an auditor or an accountant, I might not be aware of, right? I might not be reasonably expected to be aware of whether this is the best company in the particular industry. whether the particular company is the best organization in the country. So might not be known. So therefore, without accurately knowing the information, if I say okay, this is the best, etc., 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 my objectivity might be compromised. Meaning I am being influenced. Okay, remember the objectivity concept that we discussed earlier. I am being somebody influenced me. So say that okay, tell that a company is a good company. Then the people will buy the bonds. If example client says okay, look here, you tell that the general public my company is a good financially healthy company. And if I go and tell that the shareholders the public will buy. If I say that okay, this company is good, financially strong, etc., 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 right? So without having without having really known them, right? My objectivity is compromised. So therefore, advocacy is you are basically confirming what the client is telling. The client is good or bad, right? When you do that, objectivity might be compromised. You might be influenced by somebody. So management might say that okay, do it. You might do that. So meaning your objectivity is compromised. So that is called advocacy threat. Then the next one is familiarity threat. Meaning what? If you have been auditing, so the whole financial statement for a very long period. If you have been working with a particular client for a long period, right? You might be flexible in dealing with the client. You might say that okay, I've been auditing this particular company for quite a long period. I know these balances are accurate. I know their management is good. I know that their inventory is always correct. Accounting records are always correct. This record is correct. That record is correct. So, for example, my previous experience, I know that okay, they have been the accurate. But when I go for the audit this year, I say that okay, so I know that I've been auditing them, for the last so many, management is good, competent, the accounting records have been maintained, well, good and all that. I will go for the audit with that mindset, no? Right? That mindset. But when it comes to this year's numbers, so there might be certain errors in the accounting records. Management might not have been on a new management or whatever, whoever the management who was running the business might not have been honest in this year. So therefore, my conclusion drawn based on my previous experience is not accurate, wrong. So that was called familiarity threat. So you conclude that everything is fine, everything is good based on your experience. And you might be flexible in therefore going through the numbers. No? If you believe that okay, always inventory is correct, receivables is correct, you might not pay due attention in checking receivables. You might not pay due attention in checking inventories. Because your conclusion was I have audited these for the last 20 odd years, therefore I know that those balances are accurate. Right? Therefore you do not check. Whereas in this year there might be a material omission or a error in the inventory or the receivable balances. Right? So therefore, that conclusion is wrong. That is because of the familiarity threat. Right? So last one is intimidation threat. Meaning what? That the threat that a professional accountant will be deterred from So acting because of actual or perceived pressure. Right? You might get, for example, actual or perceived pressure from various parties. Do it like this. For example, might say that okay, if you don't agree with us to make this adjustment, your audit will be changed. Now auditor is also ultimately at the end of the doing a business. Client so might say that okay, so they agree on this particular, agree to reduce the bad debt provision by 100 million. If you don't reduce the bad debt provision by 100 million, what will happen is, right, say we will change the audit, or we will change the audit, we will say they will not give you any other assignment from our group. That is the case, what will happen, right? So auditor might say that okay, I will lose fairly good fee income, fairly good income, etc., etc. So therefore, so what happens is called intimidation threat. Right? Intimidation. Right? You are being influenced. Right? You have been influenced because of actual or the perceived pressure. Actual or perceived pressure. Do this, otherwise will not give you the audit. Do this, will not allow you to, for example, the will not give any other assignment. Right? the actually the perceived pressure, right, will result in you might not pay due attention or due care in the auditing or providing the particular service for the particular client, no. For example, you have been given a pressure that okay, look here, don't do this. If you do this, so you will not be reappointed. You will not be given further assignment. Then what will you do? Right? There is a possibility where the auditor might be flexible, might not pay due attention, right, in auditing those numbers. So therefore, it is very important that identify. Therefore, now we discuss 5 ethical principles. Similarly, there are 5 threats, 5 principles and 5 threats which will prevent, right, so the professional accountant in complying with those ethical principles. Now we'll quickly go through them again. What is the first the risk or first threat? Self-interest. You have financial or other interest. You have financial or other interest in the entity to be the audited or entity to which you got to provide the service. Right? And then if you have an interest, you might not, in taking decision, you might be biased. Right? For example, you might not make the full provision for the bad debts. Because profit goes down, you might be affected. So self-interest threat. What is the second one? Self-review threat. A situation where you got to review or a threat arising due to you are being subject to review the numbers you have produced or your own colleagues or your own other office, the other officers in your own organization, the work. Self-review. What is the third one? Yeah, advocacy threat. Meaning what? Yeah, promote the client's opinion. Promote the client opinion in a manner where the objectivity is compromised. If you just say that okay, my client has got a the B plus rating, it is okay. Your client has got a B plus rating. But if you say okay, my client is really good, they are financially strong, right? Their management is honest. Can we say the management is honest? Can auditor say management is honest? We never know. But we just go and the review transactions. How do I know whether how can I give a guarantee or a certificate that management is honest? Can I give a guarantee that particular organization is the best organization in the world or the country? No, I can't give. So there if I say that if I am advocating, meaning confirming the representation made by the management, saying the management is honest, good, company is very strong, this and that, I cannot tell. If I tell that, so my objectivity is compromised. Meaning, my decision is being influenced by them. Because I never know. Nobody can conclude that the management is, honest and etc. 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 What is the fourth one? Familiarity threat. You have been familiar with those numbers or the organization management for quite a long period. As a result, when you are providing service, you might be lenient. You might not pay due attention. Right? It's called familiarity threat. What's the last one? Intimidation threat. Meaning what? Undue pressure. Right? Yes. Undue pressure and influence. Right? So will result in, you have to change the decisions. Right? The change the decision or not doing a professional job. So therefore, now these are the threats. These are the threats. These are the threats. Can you hear now? Okay, now what we are discussing is the safeguards. Now we identify the ethical principles, we identify the risk which will not allow for us to comply with those principles. Now we are going to discuss is safeguards available to ensure that we do comply with those basic principles, right? Now these safeguards available can be mainly divided into two. First one is safeguards created by the profession or the legislation or the regulations. Second one is safeguards in the work environment. Safeguards created by the profession, safeguards created by the working environment. So meaning your own organization, safeguards created by your own organization, safeguards created by the profession. Certain safeguards are created by the profession, certain ones are created within the work environment. So now we will go through some of the safeguards created, so which is very common in practice, right? Which is very common in practice, right? Very important also, safeguards created by profession or the legislation. Some are created by the profession, accountancy profession, or the legislation, laws and regulation of the country. What are they? First one is education, training and experience requirement for entry into the profession. Now ultimately professional accountant will have to comply with them. So therefore the profession has minimum requirement to get into this particular profession. Minimum education requirement. Education, training and experience requirement for entry into the profession. For example, it says you need to have minimum 3 C passes to start doing professional accountancy education. So to become a qualified accountant, you need to have 3 years of practical training. 3 years of training is required. You need to have so much of experience, right? Likewise, certain regulations, right, being stipulated in the profession, not that all are given an opportunity to become a professional accountant. Minimum education and training and experience is being set, established. If you are having them only, you can become a professional accountant. So when you set a minimum education and training and experience, right, during that particular period of time, if a minimum education, there's a minimum education, for example 3A passes or 3B or a 3C, meaning in a person who can understand what is good and what is bad, what is correct and what is incorrect. And while the training and experience is gathered, he can be trained as to what is ethical, what is not ethical. He will experience while acquiring the training what is ethical and what is not ethical, right? So therefore will help, right? So will help the particular member or an accountant to acquire the knowledge as to the, for example, identify the importance of complying with the ethical requirements, and how to comply with the ethical requirements. He will get to know, right? Therefore, one of the safeguards taken in the profession is set a minimum education level, minimum training, minimum experience. When you acquire them, and become an accountant, you will be fully fledged accountant who is very much aware and competent and knowledgeable about this ethical principle to be followed. Second one, continuing professional development requirement. We call it CPD, right? So it goes on to say that, okay, CPD, continuous professional development. CPD requires, CPD, now all professional accounting bodies have a CPD requirement. So it goes on to say that you need to have a relevant CPD. Relevant CPD, for example, of 40 hours for a day. Relevant CPD, right, say meaning, for example, if an accountant is in practice, he got to acquire continuous professional development, continuous professional education. For example, some education on accounting standard, some education in auditing standard, some education in tax regulation, some the knowledge on, some training on Companies Act, the changes in Companies Act regulation. When you do that, it says, okay, you need to have minimum 40 CPD, acquire from these areas. When you acquire that, now we earlier discussed, the ethical principle. It's called professional competence. Professional competence and due care we earlier discussed. I might have become professional accountant 10 years ago. But my profession requires every year for me to get, for example, 40 CPDs, continuous professional development. Meaning, acquire 10 hours of training on accounting standard, 10 hours of training in tax regulation, 10 hours training in auditing standard. When I every year acquire that CPD, or that training, my knowledge will be current. No, I am updated with all the latest changes in laws and regulations and accounting standard, auditing standard, etc., etc. Then I am professionally competent. Earlier discussed professional competence and due care. You should be knowledgeable with the latest laws, regulations, standard, etc., etc. When there is a CPD established, what professional accountant can ensure is he is updated. My knowledge is current. I might have become an accountant 20 years ago, but because of the CPD, I am educated, or I am updated with all the changes. So that occurred since the day I was qualified as an accountant. So therefore, CPD is a very useful tool created by the profession. Says acquire. Whenever there is a change in the ethical guidelines or the ethics, right, you have to be updated. Auditing standard updated, accounting standard updated, tax laws updated. Then I am updated. Every year I got to have 10 hours or 40 hours of CPD. Then every year I will be updating myself. Therefore, my knowledge will always become current, right? So therefore, I am professionally competent, right, in providing services to the client. So therefore, it's a very important one. Then the next one, professional standard, right? Professional standards are issued. Professional standards are issued, to be followed by the accountants, to be followed by the professional accountants in, their work. For example, in Sri Lanka, we have Sri Lanka accounting standard. Whenever you prepare a financial statement, you got to do it based on Sri Lanka accounting standard. Whenever you audit a financial statement, you have to do it based on Sri Lanka auditing standard. Right? Likewise, certain standards have been issued. So when the standards are issued, professional accountants cannot work the way they want to. For example, if you take an accountant will have to prepare a financial statement based on the accounting standard issued by, for example, CS Sri Lanka. Right? The accountants cannot work the way they want to. There is a consistency. You got to do it based on the accounting standard. Then auditing standard. If I am an auditor, when I do my audit, I have to do it based on the auditing standard. I will have to do it based on the auditing standard. Right? I cannot do it the way I want to. Go by the auditing standard. Therefore, standard will help. Standard will help me to, standard stipulated in the profession will help me to deliver a good job. Deliver a good job. So therefore, standard will help to comply with the ethical principle. They are again professional competence and due care. Right? Next one, professional regulatory monitoring and disciplinary procedures. Professional or regulatory monitoring, right? And the disciplinary procedures. For example, a professional, the professional organization, right? Or the regulator. Now, for example, if you take in Sri Lanka, say the audits, right? Financial statements audited by the auditors, so will be checked. For example, auditors' work, can be checked by Sri Lanka Accounting Auditing Standard Monitoring Board. In CS Sri Lanka itself, there is a separate, quality control, say the quality control division. Right? They have established, the quality control review division. So they will come and check the quality of the work you do. Right? Monitoring board will come and check the quality of the work you do. Or the Securities and Exchange Commission will inquire from you, how you did this and that. Or the central bank might come and inquire from you. Insurance board might come and inquire from you. Right? So there are certain regulators. Right? Maybe within the particular professional institution or maybe the outside. Fourth one, external review by a legally empowered third party of the report. External party, Sri Lanka Accounting Auditing Standard Monitoring Board is external party. So they will review your work. They will review your audit file. They will review your accounts and then see whether you have provided your financial, you have done your duty. You have provided the particular services based on the relevant laws and regulations. And the one before the last one, professional or the regulatory monitoring and discipline procedures. Professional or regulatory monitoring. So the institute itself monitor your work. If you are not in compliance with it, right, say you take certain disciplinary procedures. You take disciplinary action against a particular accountant. Therefore, now these are some of the, the actions taken. Some of the steps taken by the profession or the legislation to ensure that accountants are in compliance with the applicable the ethics, applicable ethical rules and regulations, right? So education, training and experience, right? In minimum you need to have these if you get into this particular profession. Second one is CPD, acquire so education on a regular basis so that your knowledge will be current. Third one, professional standard set, audit and accounting. So in a way that accountants and auditors cannot work the way they want to. So the fourth and fifth one. So the institution, I mean the professional or the regulatory monitoring. The particular professional organization or other independent organization will even check your work, right? And then so report and see whether your work is accurate, whether your work is acceptable, and etc. is being checked and reported. Now what I am going to discuss is professional accountants in public practice, right? So what are the safeguards that could be taken by the professional accountants in public practice? Meaning those accountants, I earlier said professional accountants working as auditors, tax consultants or the consultants, right? As far as they are concerned, what are the steps that they can take? Alright, so to ensure that they comply with the ethical principles applicable for them, right? Here I am going to have firm-wide safeguards in the work environment. Earlier I said certain regulations or certain controls are being introduced by the profession or the regulation. You can remember this. What I said here, certain safeguards are created by the profession or the legislation, certain manner working environment. Now what we just discussed previous slide is safeguards created by the profession or the legislation. Now what I am going to discuss is safeguards created in the work environment. Firm-wide safeguards in the work environment. Firm-wide, what is the kind of safeguard that you can take? Leadership of the firm that stress the importance of compliance with the fundamental principle. Leadership or the senior partner or the managing partner of the firm should always insist on compliance with those ethical principles. Leadership should always insist on compliance, should always remind the other partners and managers and all other staff the importance of, right? So importance of compliance with the applicable ethical principles, right? It's not that just working, so insist that okay, you got to comply with these ethical principles applicable for your organization, right? So most important one, right? So the leadership of the firm insists that the importance of compliance with ethical principles, because otherwise, for example, if the senior partner, the managing partner is not interested in complying with ethical principle, right, then other people will anyway, other partners, managers or staff might not be anyway interested in complying with ethical principles. No? Take any organization. If the chairman or the managing director is not interested in complying with ethical principles, so other directors and other managers and employees, they will also not be interested in the compliance with the rules and regulations or the ethics. So that is why this goes on to say that managing partner, senior firm, the managing director, the chairman. Right now here we are referring to the accountants in practice. So then the auditing firm or the consulting firm, so senior partner, the managing partner, right, should always insist on compliance with the ethical rules and regulations. Second one, leadership of the firm that establish the expectation that members of an assurance team will act in public interest. Senior partner will have to always remind the members that you have a duty towards the public. First, okay, you say that okay, so we need to comply with ethics. Similarly, insist that we have a duty towards the public. We have a public interest, that will have to be always reminded to the members providing assurance services in your firm. That okay, look here members, public take the decision based on the information that you provide. If you don't provide the relevant, reliable information, they will be affected. They will suffer a loss. Therefore, remember that, and provide your services to the client. Ensure that public will not be affected. Public will not be penalized due to, due to your work. So meaning, provide accurate, relevant, reliable information for the stakeholders or the people. Third one, policies and procedures are established to implement and monitor quality control of the engagement within the organization. Now, most of the organizations are having this, the policies and procedures are established. Within the organization, policies and procedures are established, right, to ensure that you do comply, the certain policies and procedures are established within the firm. For example, it might say that okay, the firm might require for you to acquire 20 hours of CPD every year. Profession also might tell, while firm might also be aware. So there are a lot of international firms, where they have this requirement. If you are auditing a bank, you need to have, for example, 10-20 hours of training relating to banks in that particular year. Otherwise, you can't do an audit on bank, right? So therefore, likewise, there might be certain rules and regulations, policies and procedures established within the organization. Right? For example, to avoid the familiarity threat, it says one partner can handle the audit of a particular client only for 5 years. Parties always been rotated. Internal policy. If a partner is rotated, what threat you can avoid? If an engagement audit partner is being rotated, what threat you can avoid? Familiarity threat. If you have been auditing the same organization for quite a long period, you will conclude that okay, everything is fine. You will not pay due attention, more attention. So you know that based on your experience, you might conclude that okay, I know everything, everything is fine. But within the organization, there is a procedure that okay, look here, partner can handle an audit only for a 5-year period. Thereafter, work will have to be rotated. Internal policies and procedures, right? Self-review threat. So, for example, so the firm will say, firm has an internal policy. We will not undertake accounting and auditing both work of an organization. If you do accounting and auditing both, you will be subject to self-review threat. No, you prepare financial statement, same financial statement, you will be auditing. The numbers you have presented, numbers you have generated, you are auditing. Then even if that is wrong, you tell? You will not tell. Then we are subject to self-review threat. No. Therefore, in the organization there can be a rule or a policy or the procedure established that so if you are doing an audit, you will not undertake accounting. You will not undertake accounting, auditing both of an entity. If you do not undertake accounting and auditing both, you can avoid what? You can avoid self-review threat. Self-review threat. Third, I am giving some example. Say internal policy and procedures. Say organization, firm might be having this thing. If a partner is a shareholder, right, of an entity, audit client. If a partner is a shareholder of an audit client or having a material financial interest, he will not be allowed, right, to conduct that audit. For example, if I am auditing a company, if I am having some equity interest, or if I am having, for example, some other, the interest, other financial interest or other interest. So a firm is having a procedure, I got to declare that to the other partner, and I will not be permitted, I will not be allowed to undertake that particular audit. Right? I will not be permitted or allowed to undertake that particular audit. Right? So to get away with what? Self-interest threat. For example, I am having an equity shares of another entity. There is a policy in the firm, if you are having an equity shares of another audit client, policy of the firm is what? You will never be allowed to do that audit. I am having another interest. My spouse is working as the finance director. My son is working as the finance director. If that is the case, I will not be allowed to handle that audit as a partner. So, will have to be handled by another client, another partner or another manager. Therefore, you can get away with what? Self-interest threat. So, therefore, the firm might be having, its own internal policies and procedures to get away with what? Get away with, so these threats, get away with the threats. Therefore, one is, first one, leadership firm said, okay, leader, senior partner said, okay, always comply with be aware of the ethical principles, comply with the ethical principles. Second one, always remind the people, the public, we have a public interest, duty to the public. Public take the decision, therefore be mindful in providing the information, ensure that public is not affected. Third one, so the firm internally you have policies and procedures as to how to deal with the ethical, how to comply with ethical principle, how to deal with ethical threats, right? You know, you having the establish the monitor, implement and monitor the quality control engagement, right? You having those in your firm. Next one, document policies regarding the need to identify threats to comply with fundamental principle, evaluate significance of those threats and apply safeguards to eliminate or reduce the threats to the acceptable level, right? You have the policies. Now, for example, earlier what I said was, right, you need to have the policies. You need to have the policies, right? These policies will stipulate policies regarding need to identify threat to comply with the fundamental principles. More importantly, evaluate the significance of those threats and apply safeguards to eliminate or reduce the threats to an acceptable level. Now, those policies, whatever earlier I said, you know, documented within the organization, right? So, go on to tell that, okay, how to identify threats, how to identify whether it is significant, and how to eliminate those threats or how to reduce those threats to an acceptable level will have to be documented. First one, okay, you have to document, you know, the how to deal with ethical principles, how to identify them, how to evaluate whether they are significant, right? And how to get rid of them or reduce them will have to be appropriately documented and shown. Is called, say, the fourth one. Then the fifth one. So, the documented internal policy and procedure requiring compliance with fundamental principles, right? So, you need to document internally, document internal policies and procedures requiring compliance with fundamental principles, right? Now, within the firm, right, there should be documented, you know, the regulation, documented principle, okay? These are the ethical principles applicable for us, right? Say the confidentiality, professional competence and due care. This is what it is. This is how you got to ensure their professional competence and due care. This is how you got to ensure the confidentiality. So, likewise, you identify the basic ethical principles and document how you got to comply with these, the ethical principles applicable for your organization. There were the principles and you got to comply with those principles should have been documented within your organization. Last one is timely communication of a firm policies and procedures, including any changes to them to all partners and professional, the staff. What you got to do? Okay, having policies and procedures itself is of no use. Whatever the policies and procedures that was the developed or that was documented will have to be communicated to the all partners and managers. Otherwise, you know, the document, all these policies, procedures might have been developed, but might not have been appropriately communicated to the whole other partners and managers. In which case, you know, they might not comply with them because they might say that, okay, I was not aware of, I am not aware of them, right? So, therefore, might have an impact. So, therefore, they are the most important regulations, right? So, the most important, you know, the steps organization can change, organization can take or the firm can take to comply with the ethical principle. Now, again we will summarize. For example, what we discussed was, you know, what are the steps a firm can take, right? Comply with the ethical requirements. First one, senior partner or the managing partner will have to always insist on complying with the applicable ethical principles. We got to say that, okay, so our duty or our work will have to be carried out in compliance with the ethical principles applicable for us. What is the second one? Second one, he will have to always inform the all members providing assurance services. We have a public interest or a duty toward the public. They have to provide relevant, reliable information. And third one is, you know, you have to document, you know, policies and procedures. How to identify, you know, the threats. You know, how to evaluate them as to whether it is significant or insignificant. And then how to deal with them. How to eliminate them or how to, for example, you know, reduce them to an acceptable level. The next one, you know, you have to stipulate, document what are the basic ethical principles we are exposed to and then how to get rid of them. Now, Earlier one what I did explain you all was when you come across how to deal with that, no. If you come across, the violation of ethical principle, how to evaluate it, whether it is significant or insignificant, etc., etc., etc. But now what I am telling is, now basically the ethical, what are the risks, that will prevent you from complying. You identify, okay, these are the risks. For example, self-review risk, self-interest threat. These are the risks that you might be exposed to in complying with ethical principle. Now, this is how you got to deal with, right? How to get rid of self-review threat. For example, you can say that this is a self-review threat. So, if that is the case, don't undertake audit and the accounting work together, right? No partner will be permitted to undertake accounting and tax work together. So, meaning, right? So, steps taken, to identify the risk and then given the measures to be taken to, right, get rid of the risk. Then be the partner or account manager working, then I know, okay, these are the risks we are exposed to. These are the steps I got to take to get rid of those risks. So, there was very easy and convenient for me to get rid of those risks, right? So, then the next one, right? Next one what we discuss, whatever those, right, the policies and procedures established and documented will have to be communicated. Will have to be communicated for all the parties, so that those risks could be, the partners and managers will ensure that they will comply with them. This is the procedure, for example, within the firm. Within the firm you can establish, right, to ensure that you are in compliance with ethical principles and regulations. The next one is engagement specific safeguards. If you take an audit engagement or a non-assurance engagement, within that engagement, what are the steps that could be taken to minimize or to comply with the relevant ethical guidelines? First one, having a professional accountant who was not a member of the assurance team review the assurance work performed or otherwise advise as necessary. Now, so I need to see whether I provide the right service, whether the financial information given by me is accurate, right? Whether service provided by me is accurate, because public will rely on my information I am going to provide. So, then if the information that I provide is wrong, public might be affected. Therefore, what I do is I get an independent person within the firm. For example, 3 of us got together in providing this particular service. Once we complete our work, before giving to the public, before giving to the stakeholders, we get another person within the firm, independent person, who did not get involved in the work enough to review the work that we did. Review the work that we did and see whether the work we have done or the financial information we have compiled is accurate. Now, 3 of us got together and provided, compiled certain information. 3 of us worked on that. Before giving that information to the public, what we do is, identify another competent, suitable person within the organization, and we'll get him to come and check and see whether the information, right, given by me is accurate, whether the information compiled by us are accurate. We get him to check, so that before the information is given to the public, that information will be checked by somebody. That information will be checked by somebody. Therefore, all these inaccuracies can be minimized, can be avoided. Then the next one, consulting an independent third party. Now, here what I was explaining is, within the organization you take somebody, consult an independent third party such as a committee of independent directors, a professional regulatory body, or another professional accountant. Now, what you do is, before you release this information to general public, you consult. You consult an expert or a group of directors or another, the group of people. You consult an independent expert or independent, directors or independent group of directors and tell them, okay, this is what I did, check and see whether the work I have done is accurate. Now, earlier scenario, what I said, take a person within the organization. Now, here what I am telling is, take an outside party, outside expert, and wanted him to come and check the work I have done and advise me whether the work done by me is accurate, whether financial information compiled by me is accurate. Will have to be checked. Will have to be checked. So, that is the second one. Then discussing ethical issues with those charged with governance of the client. Those charged with governance refer to the board of directors. Whenever there is an ethical issue, whenever there, for example, there is a conflict of interest, whenever there is an undue pressure, right? Whenever there is a self-review threat, or whenever there is an ethical issue, you always go and discuss with the client's board of directors. Those charged with governance of the client, meaning now you have the client, you are providing certain services for the client. Now you have confronted with an ethical issue. What you do is go and discuss that particular ethical issue with the board of directors, so that you can take an appropriate and more suitable, relevant decision, right? More suitable, relevant decision could be taken. Then rotating senior assurance staff personnel, what I earlier discussed, right? You rotate, now this engagement specific, safeguards, no? Engagement specific safeguards. What you do is, you change the engagement specific person. For example, 3 of us were auditing this particular audit, or we were providing this particular service for this particular client for 5 years. Now what we do? All 3 staff members will be changed. All 3 staff members will be changed from providing the particular service, right? All 3 staff members will be changed. We will not provide any more service for those clients. 3 new staff members or 3 new partners will provide that particular service. We call it, rotating partners and the senior managers involved, so that, self, what threat can be mitigated? Familiarity threat. If you rotate the people, familiarity threat could be mitigated. So those are some of the engagement specific safeguards. Now we will go to the final one under this. Professional accountant in public practice shall evaluate the significance of any threat. Now all this what we discuss is, some measures that could be taken to mitigate. Some measures that could be taken to mitigate. Now assume that, okay, now those, for example, having internal policies, procedure, managing partner telling how important this and that, rotating partners and this and that, those could be taken to, so to ensure that you comply. You will not violate those ethical principles. Now assume that you came across, the ethical principle or the violation of, ethical principle. What you got to do? Now you came across. Then what you got to do? Professional accountant in public practice shall evaluate significance of any threats. Evaluate significance of any threat and apply safeguards when necessary. What I was explaining you all. When necessary, eliminate them or reduce them to an acceptable low level. Either to eliminate or reduce them to an acceptably low level, right? Example of such safeguards. Safeguard that we can take, some more, right? Now we came across ethical issue. Now what you go to, for example, you are now subject to, for example, self-interest threat or a self-review threat or whatever it is. Now what you got to do? One is withdraw from the engagement. You came across a significant, ethical issue, evaluated and it was identified to be significant, what you could do is withdraw from the engagement. You withdraw from the engagement for the client. Second one, supervisory procedure, meaning what? You get internal person or an external person to come and check your work and advise you whether your work is appropriate and good. Third one, terminating the financial or business relationship giving rise to the threat. They have been providing, for example, accounting service or audit service, tax consulting service, this and that. But there was a threat in only providing assurance services. Therefore, what will you do? Provide only the terminate providing assurance services. You continue to provide tax consultancy and other services. You have been providing tax, audit and etc. 3 types of services. Tax, audit and company secretarial for assume. Or there was a conflict or there was an ethical issue relating to providing audit services. Then you terminate that service. You stop providing auditing service. But you continue to provide other services you have been providing. That is the third one. Terminate the financial or business relationship giving rise to the particular threat. You are not going to withdraw from the entire engagement. You provide other services, but this particular the service which rose or which the gave rise to the conflict, you terminate that. But others you can basically continue. discuss the issue with higher levels of management within the firm. For example, if you came across an issue, then if there are some senior partners and managing partners and all that, you basically discuss the particular issue with them and then take an appropriate call. So therefore, these are the ones, which the ones that you can, the firm wise you can take if you confronted with ethical issue. Okay, just to summarize, this is all what we got to understand or what we got to learn under this particular topic at your level. Now, what I was explaining, we will quickly go through what I was explaining you all. We being accountants, we have, as far as the accountants are concerned, we have a public interest. Public will rely on the information that we give and take the decision. Therefore, we have a public interest. So therefore, so the IFAC goes on to say that whenever we provide services, we got to comply with certain ethical principles. Right? They have introduced, the ethical principles to be complied by the professional accountants. Now, these particular rules introduced by them, there are 3 sections. Section A, right, applicable for all. Section B, applicable only for the accountants in practice. Section C, applicable only the accountants in business. Right? Now, what we will be discussing here is only the ethical principle applicable for the accountants in practice and accountants in business, both. Section 1, applicable, equally applicable for both. Right? So I explained you all there are 5 basic ethical principles to be complied with by the professional accountants. What are they? First one is called integrity, being honest and straightforward. Second one, objectivity, not to be biased. Right? Third one, professional competence and due care. Ensure that your knowledge is current and provide a relevant, good service for your client. Fourth one, independence. Right? You should not, not the independence, confidentiality. Confidentiality. You should not disclose the information you get hold of while providing the services to any other party. Or you should not misuse that information for your personal advantages. What is the last one? Professional behavior. You got to comply with applicable laws and regulations in providing services. Now, those are the ones that we got to comply with. And then I said that, okay, there are 5 risks. So, which will prevent us being complying with those 5 ethical principles. There are certain risks which will prevent, which will not allow us to comply with those ethical principles. What are the first one? Self-interested. You have financial or other interests of the particular client. Second one, self-review trait. You got to review the information you or one of your colleague has compiled or produced. Third one, advocacy trait. You are advocating. You are basically confirming, make representations on behalf of your client. Right? Fourth one, familiarity trait. Either being engaged as an auditor or a practitioner or a providing service for a particular client for quite a long period and taking a call. Right? Saying that without checking, adequately, those numbers are accurate, etc., etc. Last one, intimidation trait, meaning what? Undue influence or the pressure, right? Undue influence or the pressure, right? So, will prevent you being complying with the ethical principles. So, therefore, now what I said, okay, now these ones, right? So, will prevent you complying from the ethical requirement. So, therefore, now we got to ensure that we comply. Now, as far as the compliance is concerned, now certain ones for us to comply, the regulations have been introduced by the profession. Ensure that accountants comply with the ethics. Certain regulations have been introduced by the profession or the regulation itself. Certain ones are by the work environment itself. Now we discuss some of the ones the introduced by the profession itself. What are the ones introduced by profession itself? What are the principles or the rules established by the profession or the regulation to ensure that you comply with the ethical principles? What are they? You establish minimum education, right? Minimum education, minimum qualification, minimum training, minimum experience for the people who get into the profession. What is second? CPD, the standards, right? So the minimum, the standard you got to follow. What is fourth one? Yes, right. So within the profession, now you establish certain policies and procedures, right? Say the independent somebody from the profession will come and check your the whatever the work done and see whether that is in order. And then the next one, independent the entity like Sri Lanka Accounting Auditing Standard Monitoring Board will come and check your the work done and see whether they are accurate. Provide the relevant reliable information for the stakeholders. So those are the ones the introduced by the profession or the regulation to ensure that you comply. And then I said the firm specific. Firm might have taken or the particular organization might have taken certain steps to enhance, to ensure that organization is in compliance with the ethical principles. First one is senior partner set the tone and always remind the employees to comply with ethical principles. Second one, always remind the employees about the public interest, right? Public interest and get them to comply with. What is the third one? Yes, so you have established policy and procedures, right? So the first one is identify the risk you are exposed to, right? And then how you got to comply with them. Self-review, self-interest, etc. How you got to comply. You establish procedures within the organization, right? What are the risks you are exposed to, and then how to comply with them. Next one is you document the procedures if you came across a risk. How to evaluate whether it is significant or not. And once you evaluated if it is significant, how to get rid of it, how to eliminate it, or how to reduce it to an acceptable low level will have to be documented. Next one is whatever those policies and procedures documented and established will have to be communicated to the all relevant partners and managers, say appropriately. Now those are the firm specific steps that could be taken to comply with the ethical principles. And then I took you all through say the engagement specific procedures that can be taken, right? For example, rotating the partners, right? You can rotate the partners. You can get a independent another partner to come and check your file. We three of us were doing the audit. We get an independent person to come and check, right? We get a person within the firm to come and check. We get an independent outsider to come and check. Rotate the partner. There is another step that could be taken. Then we discuss finally safeguards. Withdraw from the engagement. Supervised procedure. Terminating the financial business relationship. Giving rise to the threat. Finally, discuss it should be the higher levels of this one. So therefore, these are the very simple. We have been discussing, summarizing all that, ensure that you understand better. So these are the risks you are exposed to. The basic ethical principles. So you got to comply with the risk that will prevent you from complying with them, and then say the measures taken by the profession or the regulation to ensure that you comply with, and the measures taken by the firms, right, to ensure you comply with. Then the next one is the engagement specific, the step that can be taken to ensure you comply with. Finally, the safeguard that can be used, right, to ensure that so you comply with this. So therefore, this is basically what it is, right? So ethical principles and basic ethics part of it, you all got to be aware of. That's all about it. And then maybe we will take another 5 minutes now to discuss about the recent development in the auditing profession, right? If you take the recent development in the auditing profession nowadays, the mostly traditionally we have been always the auditing was done on a manual environment. Auditing was done on a manual environment. Risk assessment was done manually. Sample selection was done manually, right? But audit procedures were selected, audit procedures were determined manually by the auditors. Risk assessment, what to audit and what not to audit, right? And materiality level, what is the materiality level? What are the procedures to be performed? So what should be your sample? All were determined manually. But nowadays, latest development in the profession is, there are a lot of audit softwares available. Lot of audit softwares available. Recently now the IBM, US, right? They have developed a software. Now there are many software that have been there during last, the 5 to 6 years. But the latest one is IBM has developed a new software. I can't exactly remember the name, right? develop a software, and most of the work that auditors do manually now can be computerized. For example, whenever the software is installed to the client's system, okay, you have your the software in this particular computer. When the computer is linked with the, say, the client's system or client's ERP system. Now the software will go through the all financial information. The software, audit software will go through the financial the information, and then audit software will tell you what to audit. Will identify the risk areas. Will identify what to audit and what not to audit. Will select the sample. Will identify the exceptional transaction. Will help you in selecting the sample. Will help you in determining the. Will tell you this should be the materiality level. Will tell you, okay, this should be the sample. Will tell you, okay, these are the procedures you got to perform, right? And it will actually, the computer will perform certain procedures. It will go through the transaction, identify the exceptional items and give you, right? And tell, okay, as far as these transactions are concerned, provide these procedures, because computer cannot provide certain procedures. For example, when it comes to purchases, whether the quotations were called, whether the quotations were evaluated, whether the goods were purchased from the the most appropriate supplier, cannot be evaluated by the computer. For example, when it comes to purchases, one aspect is so we will check whether three to four possible suppliers have been identified, right? And then whether, say, their quotations, whether the quotations have been called from them, and then thereafter you got to check and see whether, say, the quotations have been evaluated, whether goods have been purchased from the appropriate supplier. Now those are something that computer cannot do. So computer will go through. The computer is linked with the customers, the system. Computer will go through. Computer will identify the risk case. It will identify the exception transaction. It will tell you level. It will tell you, oh, right. So these are the transactions to be. So these are the audit procedure to be performed. These are the transactions to be audited, auditable transaction. These are the audit procedures to be performed, right? Into that particular extent. Technology has, taken over some of the work auditors have been traditionally doing. Very difficult. For example, one of the most important part of an audit is, determining auditable areas, meaning doing the risk assessment. Identify the area that requires special attention in the audit. We call it identify the auditable areas, right? And then determining the sample size. Sample and the sample size. Identifying exceptional transaction. Those are most important ones, right? But traditionally we have been doing manually. But now computers have taken it over. Software, you customers, client system. It will go through all financial transactions, right? And will let us know, so what to audit, what not to audit, and procedures to be performed, sample, and then we got to perform them. And then once you feed that information, even computer will help you in determining whether audit qualification is required or not. So therefore, so those are the latest development in the profession, right? So the better that if you have, for example, in practice, now read more on to now at the moment some information is available about this software developed by IBM, right? So within maybe very soon the more information will come. You all will see that the fairly good amount of the auditor's work will be automated in time to come, right? The staff that is really required in auditing set of financial statement could be reduced, because software will take over. When you work with the software, the accuracy of the information is, accuracy of your whatever the finding is more high. When you do the manually, so we might commit, might make errors. But when the system does it, right, basically, right, accuracy is very high. It will give you exactly what to audit and what not to audit. It will tell you, okay, this is the materiality level, this is sample size, and these are the procedures that you got to perform. You get all that information. Will be really useful for the auditor, will be really accurate, and can provide a more relevant, the more accurate information for the stakeholders, right? This is basically the reason development in the profession, right? So basically that's it, what I was required to discuss with you all, right? And we'll be able to share with you all some of the example, one of the, so I will share with Chiran, right? And some say kind of a past paper, I mean not past paper, a kind of model paper to get some of the suggested answers so that you all can go through, right? And if there's any clarification or whatever it is, you all can contact us and then we'll provide you all with the required for information, right? Then with that we'll stop for today.